I mean, this is why straddles are so good during these choppy periods where we're kind of hung up between like big options resistances, because you're very likely to test the low and high end over, you know, like, let's say like 12 candles on the hourly. So if you're buying like 14 DTE straddles, and this even works on SPY because you have some theta, you know, as it moves from the lower to higher ranges, you know, you can capitalize on both sides of it. And right now, you know, we're like very hung up between 4060 and 4100. So it's a little slower, but it's really advantageous. It's more like it's more like swinging the straddle. But you can also like say, you know, you enter your straddle here, day one it falls. You know, you can exit here, re-enter the put side here, right? And then as it, you know, if it moves up the next day, you can exit the original call side here. And then as it moves, and then, you know, the next day you can re-enter a call side. And like as it consolidates, you can you know, draw the strangle back into a straddle. And then, you know, you can exit the put side, exit the call side, and then you hit volatility, right? Congrats, bulls. Now get the f out. It's not over yet. Wait a minute, I'm buying 4090. Yeah, I mean, I think you have longer than a minute. Momentum's gonna cool off. So even if we break, like if we don't break up, right, and we just chop here, momentum's gonna cool off while put positioning builds, right? If we do break up, you know, momentum is gonna spike again. And then it'll, you know, eventually we'll get a cooling off period, and then we're more likely to see downside. But remember, above 4100, they can stabilize price action in the upper range because there's call interest here. So if they can keep that call interest in the money until end of day, then, you know, they'll cash settle those contracts. So once the 4100s are in the money, since these have been held open for a while now, since they've had so much decay already, you know, it's really advantageous to get those like kind of more in the money, right? That way, you know, when they cash settle for their intrinsic value, which is the difference between, you know, the strike and spot. I don't know if we have enough volume or call interest to see 4125. Oh, on futures. Would a 14 DTE 4000p be a good play now that we're at 4100? No. I mean, I have a couple, but they're very speculative. I mean, that's super far out of the money for such a short expiry. Now, if you can like see, I don't know if you'd be able to spread it. If you have the margin to spread like a 4000 with 14 DTE, you can do shit like on days like today where we're moving into the upper range, you know, you can sell like 40, 50, 0 DTEs, and you create, you know, a really wide spread. Or ones. Ones are a little riskier, obviously, because of the overnight carry. But, you know, that can offset your theta decay. But you generally need to do this early in the day. Like, if you were going to do that, you would have wanted to have done it, you know, this morning or here. No margin for you? Okay. Yeah, so you probably want to avoid extremely far out of the money contracts. Especially with that little theta. Sometimes you have to make money on the SPY or QQQ because you're too broke to play SPX all day. That's a real thing that people should be probably considering. Well, I mean, think about it. Like, you can afford a 4000 DTE on SPX, 14 DTE on SPX, right? And this is, what are these right now? They're $15. Or on, you know, SPY, you could get like 3 4080s or 5 405s. Sorry, 408s. Right, and this is half leverage, right? For the same expiration. But you're 50% closer to the money. And then if, you know, if it hits your target of 4,000, you know, you've made $5 a contract, right? So it's $25. If this hits 40-50 with theta decay, it's going to be worth like 18. So it's you know, it's not always best, right, to have SPX given whatever your, you know, your capital allocation is. Well, the 405 is trading at 298 right now, so you could get 5 of them for $15. Alternatively, you could get like 2 4080s and then save money to either average down or, you know, buy like a call to protect your upside while we're testing 4100, and then if we fail 4100, you can cut the call. You might not make as much, but making something's better than losing it all. Do you consider entire straddle and a 10% port rule, or just a single leg since the other hedges? In the account that I trade straddles in, they are generally set at 2.5% for both legs. So, not always. Sometimes they come in a little above or below, depending on how good my entry is. But I do consider both legs the position, even though the second leg is the hedge. Although I'm rarely closing my straddles. Well, I'm generally not trying to close my straddle at a loss. Right? If you just trade the straddle like market down, right? Close both legs. The yields on this are negligible, right? It's like, you know, I mean, it's not bad. Don't get me wrong. It's like 2, maybe 3% a day, depending on how big the morning move is. Which is solid returns. Don't get me wrong. But I'm usually buying additional theta in order to, you know, capture the downside, but also, you know, because if I close here, or, you know, even if I can just, I don't necessarily have to hit break even, but even if I can close like halfway back, and this is where theta is really advantageous on straddles, is I can close the put, right, and then I can close the call here, and that, you know, ups your percentage gain to like, you know, 10%, right? 7 to 10%. And then, you know, obviously if the market's really volatile, things can get really spicy, right? And you can close here, and then you can close here, right? And then you can make like 200% on it, right? Especially if you like average, like if you close and then, you know, here you average down and then close here. Like I bought some more 4100s right here when it became really obvious that they're going to push for 4100, and that way I can close. I mean, now I can, now that I've averaged down my position from Thursday, you know, they're up, right? They're up like 4.5%. So even if we don't break 4100, I still get a 4.5% yield because I averaged them down. I do keep the average down, like the allocation to average down, restricted to the profitability of the winning leg. So, you know, if I have 10 contracts here and I make, you know, $20 a contract, that caps how much I'll average down here, right? So it's $200 times 100. And then when I average down, if I'm targeting that move, I'm using 0 DTEs, right? Instead of buying, the same. I'm not buying the same strike and date as the straddle, right? Expressive value play over time. I hope so. Yeah. It could be some time. I was really kind of disappointed with the management's lack of gumption in the last earnings. I mean, we still haven't hit the top of the channel. We did test the bottom and find resistance, but the top of the channel is still like up here. There's still a little bit more bullish momentum in the tank. But with those longer dated positions on SPY, so on SPY to kind of offset the fact that you don't get the big notional moves like you do on SPX, you have to buy more theta to straddle. Because you want increased delta exposure. And the more theta you buy, the more delta you get. Delta goes up. Right? So on SPY, if I were to do this same thing on SPY, I would probably go like 30 DTE. You can also do like 45 and then do strangles. Because if you're doing 45, right, and you're like $3 out of the money on either side, right? Then your relative delta because of theta is basically at the money. So you're like 0.5, maybe a little higher delta. So you're more sensitive to changes in price of the underlying. And that way, also you have a ton of time to close these out, but you get a little bit of a better multiplier on those smaller notional moves than, since you're not playing SPX, right? Yeah, and the theta loss also, the theta protects your downside leg. But remember, those are really conditional to these specific moments in the market where we're kind of locked, right? We're locked between that gamma neutral resistance on the upside at like 41.13, and we're kind of locked with that faster gamma and delta neutral to the downside at like 40.75, right? And that makes this range, volatile and pretty tight. And as more delta neutral positioning comes in, the range gets more volatile, right? So volatility in the range picks up because gamma starts to flatten between the two resistances, right? And so as this progresses, like into tomorrow, those straddle positions become even more profitable because the probability of seeing the low and high points increases drastically. You feel like SPX ends the day green? No, I don't think so. It's always hard to tell. The long-term momentum right now is slightly bullish. It's losing steam still, but it's still a little more bullish, right? So I would say that the skew favors the bull side, but interest is picking up to the put side. So that's going to shift as we move into like CPI, where we're going to be sitting relatively neutral. And then probably PPI following that and the Fed minutes, which are, I think, the same day as CPI, right? The Fed minutes are kind of relevant because we get the dot plot from the last economic report. I started trading with SPX and abandoned me. I never really traded SPY much on here. A couple times, like for fun, but yeah, I don't like trading SPY. I don't like QQQ either. Jimmy Burr, yeah, all the way back to 22.25. Okay, so they're going to pick up some 411 DTE SPY 405P instead of 14 DTE SPX 4000. Though I think I'll wait till 410 happens, maybe 409. So question, why shave the theta? Why not just get less leverage and not sacrifice the theta? And then like the theta offers you protection, and you already know you need to hold. So here's some problems right away. 40.50 is below gamma neutral, even the fast one, and below delta neutral. So it's going to take a significant amount of downside pressure to put this in the money, right? So you're basically buying a position right now targeting either hot inflation or you're targeting SLD. If you're targeting SLD, you're buying way too early, right? SLD's in the middle through end of next week. If you're targeting hot inflation, well, it's possible. I have some positions open for it. I mean, I'm not going to say I'm not betting on this a little bit, but I don't know how the market's going to react to like core up, headline down, right? Which is the most likely outcome. And so like this is a risky proposition, especially if you're targeting strikes below delta neutral. Because you need the market's reaction to core up, headline down to be negative. And really, it could just be nothing. Now, I will say put positioning's building, but that could just be relevant for SLD since it's far dated, right? So like the far dated put positioning that's building up, you know, that may just be to capture SLD movement and then, you know, or the entirety of the inflation prints. So you're kind of targeting a strike below resistance, and you're targeting, you know, a time period in which not a lot's going to happen, potentially. What about 0.1 delta bear call spreads 1 day out? Like April 11, selling 41.30, buying 41.35. Seems like low risk, or is the delta deceiving me due to the low theta? So the risk at 41.30, 41.35 isn't significant, right? But the profitability is really low unless you sell like first thing in the morning, or you're able to sell them in pre-market, which is super hard. Where you're losing there, where you're like, oh, this is free money, right? Because I know it looks like that, is that market makers are shockingly efficient in their pricing, even more so on SPX, right? And so you're probably going to lose in the spread. And then if the position, God forbid, does turn against you, which, like I said, is unlikely when you're targeting, you know, like a 0.5 sigma move, a little more, you know, is that, you know, now you've overpaid or, well, undersold the contract. And your losses are going to compound faster when the market maker outprices the contract.